Good morning, participants. Welcome to today's webinar on update on Union Budget for FY25 by UTI Mutual Fund. Honorable Finance Minister Srimati Nirmala Sitharaman presented her first budget for FY25 under Modi 3.0 government, marking her seventh consecutive budget presentation. Continuing on the lines of the interim budget, the Finance Minister prioritized fiscal prudence over populism while focusing on employment, skilling, infrastructure boost, and various tax reforms. To discuss more and to share the insights on the budget, we have with us our Fund Manager for Fixed Income, Mr. Sudhir Agrawal, and Head of Equity Research, Mr. Parag Chavan. Post remarks from Sudhir and Parag, we will take up question and answers. However, you can keep posting your questions on the link provided anytime during the webinar to make the most of this opportunity. Without taking further time, I will now hand over to Sudhir. Over to you, Sudhir. Sudhir, you are on mute.
Sorry. Yeah, am I audible now?
Yes.
Yeah. Good morning, everyone. So my focus in this presentation will be the broad macro changes in the budget numbers versus interim budget presented in February, and the budget which was presented now, and what will be the impact of that on the debt market. Sonal, can you share the presentation, please?
Sure.
Well, can you go in presentation mode? Yeah. Next. Yeah, so the key changes in the budget numbers. So again, as I've just discussed, we are trying and comparing what were the numbers in the interim budget in February versus what it is now. So if you recall, RBI has declared a extraordinarily high dividend in this fiscal year, which resulted into overall unexpected gain of close to 1.39 lakh crore. Which included higher dividend to the tune of roughly 1.2 lakh crore from RBI and other dividend from the other PSUs. So the overall dividend income has gone up for the government by almost 1.39 lakh crore. Now, there were expectations that, with this kind of a higher dividend number, there are chances that the government might choose to spend this entirely and may not go for any kind of further fiscal consolidation. But if you look at, while the capital expenditures have been kept unchanged at 3.4% of GDP, the revenue expenditure have been increased by almost 55,000 crore for the year. So that's again, to give boost to the overall consumption. So they have increased the overall revenue expenditure out of this 1.39 lakh crore worth of gains driven out of the extra dividends. Now, while I'll say this, out of this 1.39, part of that has gone to the higher revenue expenditure. Almost half of that has also gone towards the fiscal consolidation, wherein compared to the interim budget fiscal deficit of 5.14%, they have consolidated further. So if you recall, last year's fiscal deficit number was close to 5.6%. From there, they have consolidated further now from 5.14 to 4.94% of GDP. This resulted into the overall gross and net borrowing from the dated security. The government security is going down by 12,000 crore, while the net borrowing for T-bills has gone down by almost 1 lakh crore. Sunil, can you move to next slide? So the point, this what I'll try and show it in the charts as well. So the overall, we talked about 1.39 lakh crore worth of extra dividend and profits. The overall non-tax revenues have gone up by 1.46 lakh crore. So a bigger pie is coming from the dividend and profit, and then there are some marginal increases in the other non-tax revenue versus the interim budget in February. So now we will try and look at it how this 1.46 lakh crore worth of extra revenue are being spent by the government. So if we look at half of the kitty of 1.45 lakh crore roughly is being used for fiscal consolidation, while remaining half, part of that has gone into the extra revenue expenditure, which I have just mentioned in my first slide. And part of that is also used to give higher taxes payout to the states, and hence overall reduction in the net tax collection for the government, for the central government. So effectively what it means is, this part of pie, the half of this is being spent directly or indirectly, either directly or indirectly through states on the overall increase in the spending, and especially the revenue spending. And while the other half, which is roughly close to 72,000 crore, is being utilized to consolidate the fiscal deficit further. So I'll say quite a decent budget in terms of balancing the pragmatism as well as populism, and wherein they have saved at least half of that to consolidate it further. Now, the next question comes in the mind is, if they have they have reduced the fiscal deficit by 72,000 crore, why the borrowing has gone down by only 12,000 crore? So, that comes under the financing of the fiscal deficit part. So as you might be aware, whatever is the total fiscal deficit number, that is financed through different sources, including the prominent one being the borrowing from the market through longer dated GSEC securities, then short-term T-bills, then small saving securities, and then some external loans and so on. So let's try and have a look at that. If at all, the overall fiscal deficit has gone down by 72,000 crore, why it's just 12,000 crore reduction in the gross borrowing for the dated security. Next, please. Yeah, so this is the change in the sources of the fiscal deficit. Now, what we might look at is, while we talked about 72,000 crore reduction in the fiscal deficit, but collectively these two sources, which is the receipts from securities against small saving and the other receipts, these two itself have accounted for close to almost 97,000 crore worth of shortfall in the final budget versus interim budget. So what it means is, the 72,000 crore reduction, more than that is, offset by the lesser receipts from smaller savings and other receipt. And hence there is another shortfall of almost 25,000 crore versus the targeted reduction of 72,000 crore. Now, how they have planned to meet it is, they had plenty of cash surplus built during previous year, wherein they kept on borrowing, but they could not spend as much amount, and hence they had plenty of cash balances available with them. So they chose to draw down those cash balances to the tune of 1.37 lakh crore. And so 25,000 crore net extra deficit here is taken care of by this, and whatever net is left is reduced in dated securities by 12,000 crore, and T-bill borrowing is reduced by 1 lakh crore. So what they have done is, earlier they proposed to borrow 50,000 crore net from T-bill. Now they propose to reduce the overall T-bill outstanding by 50,000 crores, so a net delta of 1 lakh crore, and hence, that's how, they have distributed it in the change of the sources of the fiscal deficit. Next, please. So I'll say now, impact of this on our market, if broadly we look at, and this I'm talking about from the near term or the immediate perspective, is number one, we expect the curve to get steeper, and that's primarily because of the unexpected reduction in the T-bill borrowing. So since now they plan to borrow 1 lakh crore less from T-bill compared to what they budgeted for in February, so that should put lesser pressure on the short end of the curve. At the same time, there were general market expectations that any cut in fiscal deficit may be used to cut long-term borrowing, which did not happen. So I'll say broadly, there might be a bias for the yield curve to steepen going forward, driven by lower T-bill borrowing and no change in the long-term borrowing. At the same time, the second impact, what we will say is, we may see the widening of the spread on the bond swap. So when we say swap, that's the OIS, overnight interest rate swaps. Now, what happens is, till now, if you look at, we have seen a sharp downtick in the government, the government security yield in last a couple of months, driven by expectation of a reduction in the fiscal deficit in the budget. But now, with that event behind us, now the incremental scope for yield to fall has to come mainly from the rate cut expectation as and when they start playing out. So as we all know, rates have already seemingly peaked, and there is expectation at some point the central bankers start cutting rate. And once that happens, generally the OIS curve leads the fall in the yield compared to the GSEC, because incremental the delta for the GSEC on the lower side is no more there, and hence you may see the bond swap spreads widening going forward. Next. Now, coming to the longer term impact of this budget, or the slightly medium to longer term, for that we may want to have a look at this slide, wherein it's showing how the fiscal deficit has been falling over last, say, 3-4 years. So if you recall, during the pandemic years, it went to 9% plus kind of a level, and then from there we have seen meaningful fiscal consolidation, almost 0.8% between FY23 to FY24, and from FY24 again close to, from here to here again 0.7% kind of a fiscal consolidation. They have again guided the market that they will reduce it further to below 4.5% at least in next year. So this kind of a fiscal consolidation augurs quite well for our debt market. Next slide, please, Sonal. Yeah. So now what I'll say is broadly the overall, their strong commitment to lower the fiscal deficit further has been quite good from the debt markets perspective. And I'll say going forward, in terms of the inflation expectation, the very, very fiscally prudent budget along with the favorable trajectory of monsoon, these two factors should result into the reduced expectations on the future inflation, and which should give probably some comfort on the timing and the extent of RBI rate cuts going forward. Also, I'll say the future glide path to lower the fiscal deficit further to below 4.5% next year. That also supports the long-term demand supply dynamic over the medium term, and hence should bode well for the overall bond yields. From investors' perspective, I'll say the funds in the intermediate duration category remains attractive. The reason being that whenever we see the rate cuts start, and as we believe that if this rate cut cycle is going to be a shallow rate cut cycle, the base case we are going with is between 50 to 75 basis point kind of a rate cut going forward. Of course, depending upon the new real rate framework which RBI has announced. So based on that, we do think that the rate cut cycle is expected to be shallow, and if that is the case, the benefit of that accrues more to the shorter end of the curve, wherein the curve starts steepening as and when the rate cuts start. So with that, we believe that funds within the 1 to 5 year bucket can continue to offer decent portfolio yield to the investor. And whenever the rate cuts start, it also offers opportunity for investor to get the benefit of MTM as and when the curve starts steepening, the short end yields start falling faster than the long-term yield. So that's broadly the advice for the investor. I think overall constructive budget from the fixed income perspective, and bodes well for the overall inflation expectation, and should result into some bit of steepening of the curve, and hence helping 2 to 5 year part of the term structure.
I will now hand over the session to Parag. Parag, can we have some perspectives on the equities and the sectors?
Yeah. Thanks, Sonal. Thank you for this opportunity. So, as Sudhir already explained, that basically we find from the fixed income perspective, the budget to be good. Similarly, from the equity perspective as well. So, Sonal, if you can go to the next slide. So when we look at it from the equity perspective, so we want to go and look at the individual sectors, how they are benefited. But before that, just wanted to see the broad theme which was followed in this budget. So we were looking at 3 broad themes. The first was the leveraging demographic advantage. So we always talk about the human capital which we have, the growing working age population. And in this budget, we have seen that there are various schemes announced to improve the employability and the productivity of this workforce. So we expect more job creation and also the overall productivity increase for this workforce. So that was the one broad theme. The second part was supporting the indigenous manufacturing. So we have seen many changes in the basic custom duty structure, where basically some of the imports which are useful in terms of further manufacturing, those basically we have seen that the basic custom duty for them has been reduced, or in some cases where basically those imports were kind of affecting the domestic manufacturing, there basically we have seen your basic custom duties have been increased, giving some protection to the domestic manufacturing. We have also seen that on the MSME side, there has been much larger credit support. And with that also, they are basically focusing that MSMEs can do well. So these were basically catering to supporting domestic manufacturing in India. The third broad theme was boosting consumption. And here basically we have seen that again, some basic custom duty reduction on gold, silver, as well as the changes in the income tax structure, basically giving some higher, potentially about 17,500 rupees income tax saving in the new tax regime. So that has been given. And with that kind of higher savings, some of the consumption for the lower ticket item can be boosted. So those were the large themes. And when we basically look at it as an overview, what we see that the budget has been able to find the right balance between capex spending and boosting consumption. The earlier expectation was that maybe there would be more socialist measures, but the way we look at it, we believe that the government has managed to provide for both capex as well as the consumption funding. With that, I'll go to individual sectors, how basically some of the important sectors have been benefited. So when we look at infrastructure, so again, as the capex spending has continued, we see that infrastructure should get some benefit. So the thrust on infra development has continued. Although when we look at railway, road, defense, the growth this year is slightly lower, but again, we still see the numbers are quite good. Defense capex particularly has basically gone up by almost 10% as compared to FY24 revised estimates. Similarly, on the energy or the clean energy side, so this was after many years a first budget where we have seen announcement on the thermal power side. And basically, this kind of bodes well for energy security. We are kind of now looking at kind of energy deficit for India, and this new announcement on the thermal power plant side bodes well to have good energy security. Also, there was basic custom duty reduced on solar glass and tin copper interconnect. Basically, this is used in solar modules, which will benefit the solar module manufacturers in India. There are also some proposals on the nuclear energy, which also basically fast track transition towards the clean energy. Going to the next slide. So when there is focus on infrastructure development, there are few other sectors, adjacent sectors, which also gets benefit. One of them is metals. So because of this higher allocation to PM Awas Yojana, we expect housing construction to increase, housing construction to go up. And with that, basically, steel products as well as your ERW pipes, which are used in construction, those companies are expected to be benefited. But at the same time, because of the basic custom duty reduction on copper concentrate or some other copper products or silver bars, the copper miners in India as well as silver refiners may get impacted. At the same time, the BCD reduction on ferronickel, which is a raw material for stainless steel, that actually will benefit stainless steel players. So from the infra side, the steel ARW pipe benefit, but because of the BCD changes, the copper or the silver players might get impacted a little. Similarly, to metals, there are other sectors like cement or the building materials, which are closely linked to infrastructure spending. And with this higher infrastructure spending, even those sectors would be benefited. Going next to banks, generally, when we see a higher spending, generally your loan requirements also go up. And basically that is generally a good impact or basically benefit for the banking sector. In the urban housing specifically, on the housing side, there will be loans taken. So the housing finance companies will be benefited. There is a provision for interest subsidy under PMAY 2.0, Urban 2.0. And with that, basically, we see some kind of higher increase or basically growth in the smaller ticket size housing loans. I also mentioned on the MSME side, there is focus and there is more support given on the credit. There is a credit guarantee scheme which will be announced, and that should help the lending towards MSME sector. So overall lending side, the banks and NBFC would be benefited, but at the same time, we have seen an increase in the STT on the options and futures. With that, we'll see that the volumes in derivative transactions might go down. So that is a slight negative for the exchanges. Also, there is change in the capital gains tax rates, both on the short term as well as long term, and that also might impact overall volumes or overall trading activity on the exchanges. So those are kind of slight negative. So on the lending side, we think there is positive, but because of this STT and the capital gains tax rate changes on the exchanges or basically equity mutual fund side, we might see some negative. Going ahead, when we look at consumer sector, this is a sector where we see clearly positives. So first was basic custom duty reduction on gold, which is a large part of consumption for Indian consumers, where basically we have seen a cut from 15% to 6%. So with this shift, we expect there will be a large shift from unorganized to organized. That can happen, as well as with this duty cut, we expect some kind of price correction, which should also drive higher volumes on the gold side. So this should benefit jewelry companies. Also, because of the income tax slab structure change and that higher savings, which I already alluded to, we expect this would basically benefit smaller ticket consumption items, which is in general good for your consumer sector. Always, we keep looking out for, is there any taxation changes or taxation increase on the tobacco? So this time there was no change in tobacco taxation, which is also again a positive for the companies in the cigarette industry. So overall for consumer sector, there are multiple positives. Similarly on pharma, the positives are coming mainly from basic custom duty reduction. So here we have seen that 3 medicines, cancer-related medicines have been exempted now from basic custom duty. So that is a large benefit. Also, we have seen lowering of the basic custom duty for various medical equipment like X-ray tubes or some special alloys which are being used in the manufacturing of prosthetics. So those special alloys or all types of polyethylene which is used in the prosthetics have basically are seeing now a lower basic custom duty, and that should help the manufacturing companies in India. So that way even pharma sector is getting benefited. Next, looking at automobile, which is also a large sector. Here, again, we have seen basic custom rate duty reduction to 0 for critical minerals. And these critical minerals are basically being used either for the automobile OEMs as the parts of the body, or those are being used in lithium cell manufacturing, which is basically will benefit in the EV business. So because of the basic custom duty reduction, we believe this would be positive for automobile OEMs as well as battery manufacturers, large EV battery manufacturers going ahead. For EV, the FAME scheme allocation continued, although it was slightly lower as compared to what it was in FY24. Similarly, a couple of PLI schemes, the continuation was there, so they have been continued with similar allocation from interim budget. But yeah, we have seen a significant improvement as over FY24 device estimates. Also on the EV side, PM e-bus Seva scheme, we have seen a larger allocation now from significantly higher from 200 million last year to almost rupees 13 billion this year. So that way, even automobile, we see kind of benefits coming in, though for the small segments in that. So those were largely the sectors which we have looked at, and we think that the benefit was there, material benefit was there. But overall, as I said, the focus of the budget was on those 3 themes. And with that, basically, we also believe that the budget has kind of brought the right balance between capex. So even those sectors are benefiting, as well as on the consumption side, we are seeing some boost, and even those sectors should get benefited. So that way, overall, largely a good budget from the equity perspective as well. With that, I hand over back to the Sonal.
Thank you, Parag, and thank you, Sudhir, for sharing your insights. The floor is now open for question and answers, and I invite participants to keep sharing their questions on the link provided. While we wait for the questions to queue up, let me begin with the questions that we have already received. So my first question to you both, Sudhir and then followed by Parag, is what according to you is the hits and misses for this budget?
So I'll say the biggest hit from the budget has come in form of unexpected fiscal consolidation, which has surprised everyone positively. The market expectation was that the fiscal since they have already consolidated from 5.6 to 5.1, there might not be any further fiscal consolidation. So I'll say that's a big hit, at least in terms of the market expectations. In terms of misses, I'll say a higher allocation going towards revenue expenditure. Probably we expected a little bit more could have gone to further increase the capex since they had already the cushion of our higher RBI dividend. So I'll say some allocation could have gone to the higher capital expenditure, which in turn could have boosted the overall supply side factors and hence resulting into the overall increase in the demand over long term. So that's probably one miss where we would have expected more.
Taking it from the equity perspective, again, the biggest hit would be, as I said, before the budget, we would have expected more focus on boosting consumption. And there was a thought process that the capex spend would be basically significantly lower. The way we look at the budget, the biggest hit is basically that we see the right balance, right? So we have seen some focus on consumption spend, consumption boost, but at the same time, the capex spend hasn't been impacted, and we see that the capex spend has continued, even grown as compared to last year. So that I would take as the biggest hit. Also, when I looked at those broad themes, so basically even those broad themes on the employability side, increasing the jobs. So basically the job ability should go up, and in general, the productivity of the workforce will increase. That should be taken as a long-term positive for India, because that basically allows us to leverage our demographic advantage. So those I will kind of consider as the long-term positives and the biggest hits. On the misses side, the change on the capital gains tax structure was something which was kind of unexpected. That basically then increases the tax outgo, and then in general how the investing will look like. So that might change a little. But they have also given some offsets. So basically your limit of the long-term capital gain has been increased from 1 lakh to 1.25 lakh. So that will offset some of that impact. On the real estate side, so basically we have seen the benefit of indexation has gone now, so it is not there. But at the same time, they have tried to offset that with lowering of your long-term capital, basically the tax rate from 20% to 12.5% going ahead. So we see that there was some misses. So because of this capital gain tax rate structure changes, but they also tried to minimize the impact, offset the impact by basically giving some other benefits there as well. So those I will basically kind of consider as some of the misses then.
Thank you, Sudhir, and thank you, Parag, for this answer. Then my next question is to you, Sudhir. The gross market borrowing for FY25 in this budget has been reduced to 14.01 trillion, slightly reduced from the earlier numbers that they had presented in the interim budget. So what does it have impact for the fixed income investors?
So I will say the overall reduction in the GSEC borrowing has been, I'll say, only marginal from 14.13 lakh crore to 14.01. So I don't think that has a very large impact on the markets, especially the fixed income markets. But I'll say a bigger impact comes from a sharper reduction in the short-term borrowing. because there the change has been close to almost 1 lakh crore. So the impact for the market will be a steeper curve on the fixed income front, since the long term there has not been meaningful reduction in the borrowing, but on the shorter end of the curve you have seen almost 1 lakh crore worth of reduction, and hence you may see a curve which is steeper going forward and with shorter end rates falling sharply when compared to long term yield. And of course the short term yield also got the benefit of easier liquidity now with the government starting to spend their money. So I'll sense these two things will complement and might result into a steeper curve going forward, benefiting shorter end of the segment.
Yeah, so actually you covered my second question on the borrowings, reduction in borrowings at the shorter end. So I will now move over to you, Parag, for my next question. The FM highlighted that appropriate changes will be made into insolvency and bankruptcy code to reform and strengthen the resolutions and the times. So how is it going to benefit the banking sector?
So basically, I mean, if we look at just the history, so when basically IBC was launched, right? So actually, if you go even before that, right, when the IBC wasn't there, what we used to see was there were many companies who used to take higher amount of debt. So overall, the debt level at individual companies used to be much higher. The one of the thought process was that from the promoter side, even if the debt was higher, they weren't getting impacted. There was no way, no easy way that basically the control of the company would be taken away from the promoters. Once the IBC came in, we saw that change. Now, from the promoter perspective, now they had that risk. And with that risk being present, and we actually saw some of the initial cases, the large cases, right? So basically Tata Steel or Bhushan buying some of the steel plants through IBC route, the promoters kind of realized that now there is a real risk that if the debt is on the very higher side, you will basically be impacted, and the company, their own company, the control can be taken away from them. And with that, we have seen in last few years that actually many cases got registered with IBC, and we have seen a successful resolution on that. Going ahead with more resolution, or basically more stronger framework, we expect basically that this process will keep on getting better. And with that, basically the company behavior in terms of how they take the debt or basically how they service the debt will actually be much, much better, much more improved. And this basically has a direct impact on the bankings or on the NBFC sector, because then going ahead, we expect overall the NPAs or basically the risk on the default from the companies should be much lower. So because the companies are taking prudent amount of debt, so the risk on the defaults should be much lower. That should be the biggest benefit which should be there for the banks and NBFCs. One would say that because of this, overall, when the companies are taking prudent debt, or the overall debt growth, or basically the loan growth might be lower for the industry. But I think the way to look at it, that will be, it will be actually a right amount of growth. So rather than basically growing significantly higher, but increasing the risk of defaults, you would basically be growing at the right rate, and the risk of default will be much lower, which is definitely a big positive for banking and NBFC industry.
Sure, thanks, Parag. My next question is to you, Sudhir. The government of India, RBI has issued a significant, more than expected dividend to government of India. And in the budget also, a part of this dividend is being used to reduce the fiscal deficit. So what is your view? Will this be able to help in stabilizing the INR, and will it drive bond yields to lower down?
So I'll say the important thing now to watch out for is whether these kind of higher dividend number, while we have seen impact of that being passed over to the higher spending as well as higher fiscal consolidation. But can these kind of higher dividend sustain over next, say, coming 1 2 year? So for that, we have to look at what are the sources of this higher dividend. So if you look at broadly when compared to the year before, this year the RBI dividend has been much higher because of higher income at the RBI's end. Now that's coming primarily from 2 3 sources. Number one, because those forex assets which RBI holds, compared to an year ago, the overall interest rates globally have gone up, and hence which have resulted into higher interest income for the RBI on those foreign securities because of the higher yields globally. Number two, in last, I'll say 1 2 years, when the Fed, US Fed was, and the other central bank, of course, were on hiking trajectory, there were MTM losses onto their holding of those foreign security, which this year, considering that the US Treasury yield and the other global market, the Treasury yields have been close to constant, so there were no mark-to-market losses on that front. But going forward from the next 1 2 year perspective, there are expectations that the global central banker might start cutting rates. So apart from the higher accrual income compared to 2 3 year back, which might continue this year or maybe for next, say, 1 2 year, you may also see the benefit of MTM gains, starting going forward. So I'll say the overall, the sources of income looks bright for the RBI, and hence, there is decent chance that going forward for next, say, 1 2 year, at least these kind of high RBI dividend might continue to accrue to the government. Now, with that, I'll say that should support the government in overall further fiscal consolidation, number one, going forward. And then, of course, give a boost to the consumption by way of spending part of those higher dividend through either CAPEX or REVEX. So my sense is that should be overall positive, both for the GDP growth through higher expenditure, as well as lower the inflation through, I'll say, the lower fiscal deficit, and hence supporting the overall country rating. From INR perspective, that can be good because the INR ultimately also behaves on a couple of factors. Most important of that being what are the country growth expectation, which might get a boost from the possibility of higher expenditure driven by these higher dividend. And of course, the second factor, the fiscal consolidation, which may at some point result into maybe, some expectation of a country rating upgrade, if at all, and then that may support the INR going forward.
Sure, thanks, Sudhir. My next question is to you only. How do you see the impact of this budget on the inflation targets for RBI and for the monetary policy? Will RBI, do you think, will start to look into rate cuts considering the numbers that the budget has presented?
So broadly, I'll say this is incrementally positive. For the reason because they are choosing to save a big part of this money, what is coming to them, and pass it on to lower the fiscal deficit further. So I'll say overall, it's a positive from the inflation perspective, because if you see more and more fiscal consolidation, that results into the overall expectation of inflation coming lower at some point. So from the inflation perspective, I'll say it should be good, along with, of course, the other factor which I just mentioned, the near-term monsoon progress has been good. So my sense is collectively these two factors should give some degree of comfort to the RBI going forward on the inflation trajectory, and at some point may result into a slightly earlier rate cut compared to what it could have been without this kind of fiscal consolidation.
Yeah, thanks, Sudhir. My next question is to you, Parag. Will the budget's measures on infrastructure development spur private capex recovery?
So, as of now, what we are seeing is government is focusing on its own capex. So basically, the public spending, basically government capex, is definitely getting boosted. We haven't seen any specific proposals or provisions for basically the private capex to start, right? So in earlier years, basically government had given some SOPs or some benefits for new manufacturing units set up on new capex, right? In the last year or this year, we haven't seen those benefits again. So there are no specific provisions to basically increase the private capex. But yeah, I mean, at the same time, when basically government is increasing spending on road or the railway or the defense, that basically means that the related impact or basically the adjacency impact will be there for whichever the manufacturers are there in the domestic industry. So that those companies will definitely are basically supported or basically encouraged to have higher capex. Similarly, there are definitely steps being taken to increase domestic manufacturing, right? So basically, the changes in custom duty, basic custom duty, is basically going to help some of the domestic manufacturers. So with those steps, also you would see higher inclination that the new manufacturing can be set up, because basically in general, the manufacturing in India, domestic manufacturing is now more beneficial, or basically they have higher benefits because of the changes in custom duty structure. So with those kind of provisions, they are basically encouraging more and more companies to basically set up more plants, basically in the capex to increase. So although there are no specific provisions to benefit new capex, from these other provisions, basically we would see that some more manufacturing benefits have been given. So the manufacturing should go up, and that should result into some higher private capex as well.
Thanks, Parag. My next question is to you only. Which defensive asset classes do you look at becoming cheaper in this budget? Do you see an increase in allocation into them going forward?
Sorry, so can you repeat the first part? You mentioned which of the defensive asset
Yes.
classes becoming
Cheaper, or how do you see your view on the defensive sectors, if you can see?
So generally, you would consider your consumer, IT, pharma to be the kind of defensive sectors, right? And these sectors basically, as I again said, that we definitely see a boost on the consumption side. So that way, consumption should definitely be benefited, and we should see a spur on the consumption side, which should basically see good days going ahead for FMCG or consumer staples and those kind of sectors. Even on the pharma, because of pharma manufacturing, in terms of those equipments, we have seen basic custom duty reduction that should also benefit. So those were clear benefits for those two. On the IT side, we haven't seen any specific, but again, the one of the main pillars of this budget was improving the employability or improving the productivity, which should in turn basically result in a better structure or better benefits for the IT industry, which is basically one of the largest employers in India. So whatever basically government is trying to do to improve the employability, that will definitely benefit the IT sector in a way. There were also small changes, like basically removal of angel tax on the e-commerce side. Basically, they have reduced the taxes. So with those small benefits, also some segments of even IT companies should get benefited. So again, on the consumption side, definitely they have done, and that sector definitely gets benefit. That's which one of the defensive sectors. But on pharma and IT also, we have seen small changes which will benefit those sectors as well.
Thanks, Parag. So my next question, no, to you only again. Where do you see, the allocations to PLI schemes, on which sectors should be, how it will increase or decrease, and the contribution will go more to?
So in terms of that, again, I mean, government has already indicated, so the auto is already seeing PLI schemes being continued. So there we would see some benefit. And so the large schemes which we have seen was basically on the auto side and as well as on the electronic manufacturing side. Right. So both those cases, basically, we have seen further support. So from FY24 to 25, we have seen increase in the PLI schemes, both for auto as well as electronic manufacturing companies as well. So we would expect that basically those benefits and those sectors basically will keep benefiting on the telecom equipment side also. So I expect those will be the sectors which will see further benefit. There is also PLI on the white goods side, which is consumer durable, which is expected, although wasn't announced, but is expected to come in. So I believe those are the sectors which will keep benefiting from the PLI side. Government hasn't indicated anything for any new sectors. So that call basically, I mean, we don't know. We'll have to see whether there will be any new announcements for any other new sectors. But these existing sectors, we definitely see that the government is continuing to provide benefits on the PLI side, and that should continue.
Thanks, Parag. In the interest of time, I will take two more questions. Sudhir, my next question is to you. This investment has been kept unchanged compared to FY25 interim estimates of 500 billions. So what is your view here?
So I'll say for that, we will need to wait and see. Clearly, if you look at historically, there has been an undershoot on the disinvestment target, and hence, to be seen if at all they are able to realize these kind of at least such kind of high disinvestment target. But I'll say they have enough degree of cushion available through other sources. So even if, let's say, they undershoot this target, there is still some comfort coming from other sources. So for example, on the sources of fiscal deficit front, they have some kind of cushion available from budgeted lower numbers on the small savings and on other receipt front. So even if there is some undershoot there, you may still see no need to increase the borrowing because there are still other sources of funding which are budgeted quite conservatively. Also, on the tax front, I'll say the buoyancy has been kept at a low, close to 1.1 kind of a level, which is, and the absolute tax growth, if you look at, has been close to almost 10, close to 10.5, 11% this year, which is lower than, what it was realized in, say, last fiscal or year before. So I think there is enough comfort available there. So even if there is undershoot here, I think there are enough cushions available to the government to more than make up for that.
Sure. Parag, my next question is to you. What do you see the impact on arbitrage fund from the increase in the STT and short-term capital gains? Yes.
Right. So basically, because the increase in STT, we definitely expect that some kind of cost structure will go up in the arbitrage funds. Basically, wherever you are seeing high volumes, there you should see basically some kind of impact. But at the same time, I believe that some of that can be passed on as well. So we have to see actually how that pans out. In the near term, in the immediate term, we'll definitely see that basically because of this, the cost structure for these funds will definitely slightly go up. So that basically impact will definitely be there. But in the medium term, I believe that basically there can be some steps which can be taken, which will basically, I mean, some passing of the cost or basically some taking up some other steps to mitigate that impact can definitely be taken. So over the medium or to longer term, I don't believe that would be very large. In general, basically, when we are seeing that the participation in the equity markets or in the mutual funds is basically when increasing, when going up, some of these higher costs, even if basically passed on, wouldn't dent this participation in a significant way when basically the consumer or basically the investors are seeing the benefits of equity markets. I don't see that some of these basically, I mean, some of these cost increases will impact the funds directly much.
So thanks, Parag. In fact, we have received a lot of questions on taxation, change in the taxations. So I would request our viewers to please contact your financial advisors and tax experts to get more insights on how these tax reforms are impacting you. Sudhir, if you will allow me, I will take one last question for you.
Sure,
So,
Sunil.
yes, what do you recommend at this point in time? Where should investors start looking into fixed income investors, particularly? Should they start allocating their funds to longer end of the curve, or you finding shorter end of the curve attractive?
So we find both part of the curve attractive. Overall, it's a very good budget. The overall monetary policy settings have been such that it benefits the debt market investor going forward. So it's good for both, I'll say, for long term as well as short end part of the curve. It's just that on a relative basis, short end looks slightly more attractive to us on a risk adjusted basis, for the reason because we think that whenever, first of all, it's going to be a shallow rate cut situation. Number two, whenever the rate cut starts and in a shallow rate cut scenario, the curve always steepens. So when we say steepen, the short end of the yield falls much more compared to the long end, because short end reacts only when the actual funding cost moves slower. So with that, we expect that, let's say, if the say the long-term yield fall by 25 basis point, there is quite a likelihood that the short end yield, for example, 2 to 5 year part of the yield curve, falls by 50 basis point. So while in the longer end, investor get benefit of higher duration and higher absolute gain, but let's say if the fall in the yield is faster in short end and more than long term, that also remains decently attractive for the investor. So from this perspective, I'll say for investor, funds which are primarily in 1 to 4, 5 year bucket are very attractive for investor. Of course, long end fund, the gilt fund, dynamic bond fund, the medium to long duration fund, long duration fund, they are also attractive, considering that the rate cut at some point are expected to begin. But my sense is the short end still scores slightly above because of the slightly lesser volatility and possibility of a steepening of the curve.
Sure. Thank you, Sudhir. With this, I would now like to thank all our viewers for being part of this today's webinar. And I appreciate, in fact, we appreciate your active participation and thoughtful questions. And thank you, Parag and Sudhir, for sharing your perspective and taking up all the questions. To the participants, please share your feedback on the link provided to you. And stay connected with us for our future events and update. With that, have a great day. Thank you.
Thank you all. Thank you, Sonal.
Thank you all. Have a great day.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.